So I guess we can start officially now. All right, hey everybody. We are here in day 3 of the fundamentals class, and today we are going to actually talk about building out a kind of process and generalized strategy for you as an options trader. Now, we've talked about a lot of things. We talked about the fundamentals of what creates an options price, how they work, how the markets work. We talked about the Greeks and how that gives us a lot of information about overall about how the price is going to change in options. Gives us a very different view of the options so that we can really start engineering out different strategies to ideally make things work a little better. We touched on a couple of different trades, just little light ideas and basic ideas in the trades. Now today I want to go a little bit further and talk about it as an actual trader. And there's more to trading than just picking out a good trade. And in fact, I find a lot of people don't understand that, and they make mistakes because of that. Options especially give you certain ability to manage risks and control risks overall. Give you a lot of flexibility. They give you a lot of tools. The strategies and the tactics you can use are numerous, but that also makes it a little difficult to understand how you should necessarily organize things and do things and make it all work. So the first part of this session, I've got some slides. Just going to go over some really very, very fundamental concepts. And some of these are probably going to seem a little simple, maybe even a bit silly, but they all add up to what I feel is a pretty good basis for trading options, a pretty good approach to trading options. The middle part of this, I'm going to talk about something called portfolio theory and long-short hedge funds, and how that directly translates into a way you can trade options that gives you the ability to make money, and it also controls a lot of risk. Now, I see this topic come up all the time. How do I hedge off this trade? How do I make it so that I don't lose on this? Well, I hate to say it, but there is a fundamental fact in the market that anytime you do enough to make it so that you cannot lose on a certain thing, you also make it so you basically can't win. It is, every time you hedge, you're using and spending money. You're either creating a new risk, or you're basically spending money and offsetting the profits that you might have gotten, turning it overall into a loss or flat. There's different ways of looking at it than just buying a hedge, buying a long call, buying a long put to hedge off a position. In fact, there's a bunch of different ways. I like to use a broad portfolio view. The main reason for that is it allows me to use a lot of trades that are profitable, good, solid trades, and then if I do it properly and I understand how I'm approaching it and doing things, I actually build up a portfolio of trades that actually make the overall portfolio less risky than if I had just gone after that next great trade. Yeah, Lou, looking to make money without being too directional. Well, actually, Lou, I'll talk about that. In fact, one of the things that we're going to cover today is a very specific trade that I use as an insurance policy in my portfolio. Now, as far as your retirement portfolio, that actually may be a really wonderful tool for you to use to really protect yourself a lot. What we're going to focus on mostly today is actually building a portfolio of options trades and how to think about it and how to do it so that you can actually reduce your overall risk and create long-term better results for you. And I find that this ends up being a really powerful concept that people who come into options trading without the basics miss. It's so many times I see people think the best way for me to make money is for me to make a great trade. And they bust their butts trying to make this perfectly amazing trade, and they work super hard at it, and even when it's well beyond salvaging, they sometimes work at it and work at it and work at it, try to adjust it, tweak it, do all of these things. And I find that people just beat their heads against the wall against something that may not ever work. You're putting too much time and effort and focus on something that's not going to necessarily get you results. Instead, I'd rather refocus you on a bigger picture, show you how to take a wider variety of small trades, diversify your trading, diversify your strategies, and also balance things out using the Greeks to create a portfolio that ideally should work well based on each trade's idea. And when reality creeps up and knocks the portfolio around, or knocks the market around, you have a portfolio that's designed to actually fail gracefully and fail under control and minimize your overall losses. So we're going to look at that. And then we're going to talk about how different trades fit into that. And I'll give you some examples of different styles of trades and how they can actually make that idea work well. So hopefully, Lou, we'll cover some of the things that will help you and everybody else. So we're going to do basic concepts, basic but important concepts, portfolio trading, and then actually dig into a little bit of the implementation on things. Now, I need to warn you that, the sessions that we're doing here are all fundamental sessions. I am going to actually expose you to some basic trades and how they fit in together, kind of how the puzzle fits together. But next week is the period when we're going to dive into the really, really in-depth focus on the actual trade tactics. So we're not going to have, I couldn't actually do every trade that you need to go over tonight to get you there, but I can at least show you the basic concepts and how they all fit together and give you a good survey of them and how, some of the tools. So let's dive in here. Basic concepts. All right. And as I said, some of this is probably going to sound stupidly simple, but I find that some of the most fundamental, stupidly simple ideas are some of the most important ideas that people don't pay attention to. One of these, probably a stupid basic idea. Every single trade that you take needs to have a clearly identified opportunity. Now, the reason I teach this is that I have a very strong aversion to what I call ritualistic trading, where I guess the best way I could describe it is, has anybody ever told you or tried to teach you trading by saying, well, all you do is every week you put on a short bear call spread on the weekly options, and you let it go a week and expire, and then you just do it again, and then you do it again, and then you do it again. Or you take this trade, and then when you hit this thing, you do this to take the profit, and if it goes the other direction and starts failing, when it hits this, you do this step, this step, this step, and you do an adjustment. Has anybody ever taught you trading that way? If not, that's wonderful, because I actually don't like that. But if you have never really been taught before, okay, that's fine too. Well, then I'm setting you up to avoid that type of a teaching. That's what we call ritualistic trading. It's a ritual. You have a checklist. You have, just imagine a, relatively odd, bizarre religion that we're not used to, and you're watching them do their thing. Okay, walk into the room, bow to a certain corner, wash the hands, do this, do this, do this. That version of trading is effectively the exact same thing. It's a ritual. You're being told to do X, Y, and Z, and they're leading you to believe that you're going to make money doing that. There's a problem with that. It doesn't work. I'm not saying that the idea of the trade itself may not be a good idea, and in a lot of cases the trade concept is good, but trade concepts don't work in every situation. And the only way you can make money is by clearly understanding how you're going to make money. Have a clear, identifiable opportunity that you are specifically taking advantage of. Yeah, Lou, that is exactly it. Now, selling options premium, well, now, Lou, were you taught to do that with a naked short option, or were you taught to do that with a vertical spread of some type? Kind of curious. Spreads. Okay, thank you. I was gonna have a really angry moment if you told me that they taught you to do that with naked options. I would have wanted to slap somebody. But yeah, I mean, spreads perfectly fine. In concept, what they've taught you is a useful strategy or a useful tactic. Actually, let me break this down a little bit. What you were taught, Lou, was a tactic. Okay, a tactic. It is a tool for basically turning an opportunity into a profit and some guidelines on how to control that tool to minimize your risk. There's nothing at all wrong with tactics. A good tactic is a wonderful thing to know. We've got a whole week of talking about this next week. But a tactic does not make a good trade. So a good trade needs a reason to exist. So one of the things that I want everybody thinking about as they are trading is, what is the clearly identified opportunity that you believe is going to happen that makes the trade you're taking smart? You know, the tactic is used to basically turn the trading opportunity, the thing you believe is going to happen in the market, into a profit. Now, different opportunities in different situations, you know, there can be, even the same situation can have multiple trades that can turn, or multiple tactics that can turn that trade or opportunity into a profit. So that's great, but the trade has to start with a clearly identified opportunity. Now, it doesn't necessarily need to be complicated, but it does need to be very specific and very well thought out. In fact, practice this till it becomes a habit for you. What is going to happen? So it's one of the fundamental things that you're going to want to know about any situation that you're going to put a trade on. What do we believe will happen in the market? Is it going to have the symbol trend down? Is it going to, reverse on itself? Is it going to jump up? Is it going to be waffling sideways? What is going to happen with the stock price? We're options traders. What's going to happen with the options implied volatility? I mean, do we believe that the implied volatility is going to go up? Is it going to stay roughly the same? Is it going to go down? When you're trading, I strongly encourage people to have trade plans, to actually write some of this stuff out and build up a set of notes around what the trading is. You should always keep a note as to what exactly the opportunity is during your trade. What caused you to make the decision to take the trade? Why is it going to happen? This is also very important. If you don't understand why something is going to happen, you really don't understand the trade. And as I've listed here, you can come at this from a bunch of different ways. You can be a technical analyst, and you can use that to basically determine what's going to happen next. You can be listening to fundamentals, or basically analyzing the long-term growth or whatever of the symbol. Great, that could be a good indication too. Trends, just basic price movement, support, resistance. All of these basic things are useful, handy ways to describe why something is going to happen. Now, this opportunity identification, let's call it the trade thesis, the rationale behind why we want to do a trade. It's good for a number of reasons. Number one, if you become dedicated to doing this on a regular basis, it forces you to think very clearly about what you're trading, why you're trading it, what you're going after for prices, what you're going after for an opportunity, how are you turning something into a profit. Number two, and this actually becomes amazingly important, is it allows you to do something later in the trade that people don't think about very much. It allows you to manage your risks in a different way. People always ask me, how do I manage my stop loss? How do I How do I do this? How do I do that? In lieu, somebody told you to put a stop at 2.5 to 3 times the premium collected. Okay, that's a bit arbitrary. I don't know why they'd say that, but there's nothing wrong with that. But the problem is that right there will not get you an advantage in the trade. You realize that stop losses of any type never give you an advantage in the trade. They never increase your long-term profitability. What they do, and which is still fairly important, I'm not saying they're useless, but what a stop loss does is it reduces the overall variability or the speed that your portfolio swings up and down. That's what stop losses are meant to do, and they do well. Other than that, there is no magic stop loss that allows you to make more money in the trade, or on average make more money. You just hit your stop loss and you get out. That prevents you from taking a greater loss than you expected, and therefore making it harder for you to trade in the future. Now, if you have a clearly identified opportunity, there's a better way of actually managing trades. Managing trades for a reason. If a trade does not have a reason to exist, you're basically gambling. But that doesn't necessarily mean that every reason that trades have to exist, stick around, are real, or last forever. Matter of fact, I can pretty much guarantee they won't. One of the best ways of actually managing your trading is keep a note with every single trade of why you got in. What is the clear opportunity that you're taking advantage of when you got into the trade? And periodically, while you're in the trade, review that. Why did I get in this trade? Maybe 2 weeks later. Personally, I believe you should be looking at and paying attention to your trades at least a couple times a week. And that's if you've got low-risk trades that really don't move much. But periodically, like twice a week, maybe 3 times a week, just review each trade briefly. Say, why did I get into this trade? What was the reason? And review that. Does the reason still make sense? Well, if I was doing a trade off of a very clear, strong, bullish trend, well, okay, maybe that's a perfectly good reason, but suddenly the trend starts changing, it starts moving against me. Well, has that movement actually moved enough for me to reevaluate and say that trend isn't heading in the same direction anymore? Is the reason for me to be in this trade, has it gone away? Has the world changed? Now, the advantage here is that you're using the same thought process that actually makes you money to save you money from losing. You know what actually makes you money? Understanding a little bit better than everybody else what's going to happen next in the options or in the stock market, and then finding the best way to turn the options trade into a profit. That's what makes you money. Everything else is just a mechanical number system that really doesn't get you ahead. You're using the same concept to basically protect yourself from losing money. And I find that to be a very, very useful, strong idea for managing your portfolios and managing your trading. A couple of ways I would put this. Every single trade needs to have a clear, unambiguous reason to exist. Why am I putting my money in this combination of symbols to make a profit? If that reason to exist ever goes away, close the trade. Walk out. I don't care if you're in a profit. I don't care if you're in a loss. The thing that gave you an advantage in that trade was your knowledge of what was going to happen next. As soon as that knowledge is proven wrong, that's fine. It's not the end of the world, but you no longer have a clear, unambiguous reason to be in that trade. Therefore, get the heck out. Sorry, you probably hear my ice clanging around here. Just trying to get a little drink. So let's talk for a second. Anybody have any thoughts on that idea? Does that make sense? Is it, hopefully these things make enough sense to you that you'll start to actually use them and think about them as you're trading. I find that this actually makes a pretty big difference when you start really thinking about the reason for every trade, and every trade has to have a reason to exist or I take it out of my portfolio. Come on, guys. A little conversation back and forth. Men, women, sorry. Now, how many of you already thought that way? Does any of you already approach things from that point of view? Not you? Okay. Okay, that's that. Basically, that's the idea, Rob. Um, I would change it around a little bit, but and refocus it on, every trade has a reason to exist. Yeah. I mean, in a way, another way to look at this is every trade is your employee. Are they doing their job? Have you given them something to go do and accomplish, and are they accomplishing it? If they're doing their job and everything's working right, that's great. But if they're not, they're just a liability to you and they're a cost. Now, if you actually create a little system for, basically tracking your trades, and I would actually strongly encourage everybody here to get a notebook and just write notes in it as you go and basically have a trader's log. In your trader's log, put down the reason for the trade. Have the, clear reason in your head. Put it down on paper so you can read it later, because there's another advantage to this. If you put it down on paper and every trade you take has a clear reason, it allows you to learn. And that is one of the biggest long-term advantages. Now, this won't affect whether or not any one trade wins or not. But if you get into the habit of periodically going back to that log of all of your trades and saying to yourself, okay, let me look at my reason for this trade when I got into it, and then I'm going to go look back at the trade at the other end and say, okay, what really happened here? You can start assessing yourself on whether or not you're good at identifying certain types of opportunities. We're amazingly good at lying to ourselves, by the way. We think we're geniuses in a lot of things that we're actually not. Trading does not give you a lot of room for fantasy. You want to be as accurate about what you're good at as you possibly can. The best way to do that is review your own performance and figure out, am I making good choices around this? If you're not, it doesn't mean you can't trade that, but it does mean you really should be focusing on learning more and thinking about the things and just, making better decisions. If you're really good at picking directions, then you can focus more of your trades on that. If you're getting really excellent at identifying opportunities around volatility, you can focus on those. You want to be building your skills, and you can't build your skills if you blindly believe that you're amazing at something that you're not. And at the same time, you don't improve yourself believing that you're horrible at something that you're actually pretty good at. Having an honest view of that and periodically reviewing your approach to opportunities and trades gives you the ability to learn. And that is an extremely important thing in the long run. All right, so there's one of the basic concepts. Building the strategy. Ooh, yeah. Some of the trades come from vendor-supplied recommendations. Jen, I would really recommend over the long run you move away from that for a lot of reasons. Number one, you really don't know the reason or why that trade was placed out there. And I will say that in a lot of cases, especially if there's like a deadline to get a bunch of trade ideas out, people will throw stuff together fairly quickly. You can't learn from those trades and improve from those trades. You can kind of learn the mechanics of those trades and, fails, I know I can do this, and if I do this, I can do this. But if you're going to be a trader over the long run, you need to be able to trust your own judgment and trust your own opinions about things. I'm not saying you have to just dump every service that gives you trades like that, but I would try to focus more on the services that teach you the fundamentals and the background and the reason for understanding the trade. And give you the full picture for the trade rather than the services that just send out a trade alert that says do this. Like Rob, actually, Jen, were you in the option strategist group? Were you in the option strategist group yesterday when we went over and did the IBM trade? No. Okay. I believe you should have access to the service. We did a video of that, and Rob, you were there. In fact, that's what we were talking about before we got going today. Tina, you don't have access to it? Okay. I would, okay, I'm probably the wrong person to say this because I could mess up. I'm really not the salesperson. I don't know the packages or anything, but I would reach out to whoever your salesperson is, Sammy, Amber, whoever, and just ask about that, and at least see if you can get a period of time for a trial run in the service. You should be on a list that they actually send you a email that says the option strategist session is going to be at 1 o'clock today, and click on this link, and basically you're going to go to that session just like this. In fact, I use the same tools to provide that option strategist session that I'm using for this group right now. Yeah, definitely ask Amber. She'll be able to help you on that. Now, Rob, you were there today, or excuse me, not today, yesterday. When we did that trade, I didn't just throw a trade together and say all you do is you buy these, sell these, put it on, and put a stop loss at this level. One of the things I want to do is I want to teach everybody how to understand and know each of those trades. You're in the fundamentals group right now. It's good to learn this, but there's a lot of different techniques and strategies and ways of doing things, and learning those requires some hands-on time. So Rob, did you find, maybe I can get a little feedback, did that actually help you out? Do you feel like we actually covered the topic of how and why that trade works and what you're looking for and how you're using it? Was that a good session for you to learn from? Because what I'm hoping is over the long run, you learn those enough, you practice them enough, you do them enough as we are actually talking about the decisions, the information that you're looking at to choose the trade, to create the trade. You do that over and over, and then you start to understand the trades very, very well. And at that point, you're not relying on anybody to tell you what to do. You are making your own decisions. Well, Rob, I don't expect anybody to get that trade. The trade was actually a pretty high-level trade. It's a very advanced trade and quite complicated. But the goal is to expose you to it and do it enough times that if you do it 10 or 15 times, you now know it and you understand it and you understand all the reasons for it. And so that was the first step. Did you feel like you at least got a better understanding of what was going on than just maybe a trade alert that said, go buy this? Okay, good. Lou, well, how did that IBM trade go? Let me see. It's actually having an earnings announcement as we speak. Let's see how IBM just went. I don't know yet, to be honest. IBM at 163. Let's take a look. 162.88. We have one of our strikes is 162.50. If we stay relatively close to where we're at right now, tomorrow morning when the market opens up, we are going to open up into a trade that is outstanding. I mean, a really, really solid trade. If we just hit our profit target, we are going to hit a 45% return on that trade in 2 days. So now, lots of things could change between now and then, and we'll see what happens, but we stand a very, very good chance based on where the stock price is right now after the earnings announcement to nail our target and actually make about a 45% return since yesterday. That'll be closed out tomorrow morning. So I guess feedback, is that good enough for you? Is that a decent trade? Hopefully. We're looking good on that trade right now. I can't tell you the answer until we actually close it, but my expectation is that we're going to be in really, really good situation tomorrow morning. We risked, on that trade, we risked about, okay, we only did 55 contracts, not the 110 you're seeing right here. On that trade, I think we risked about $5,800 roughly. I'd have to go back to the trade and look. And my expectation is going to hit about $2,500 profit tomorrow. Overall, what the risk was? Well, the risk would have been if the stock, if IBM had gapped way out and gone past the strikes we're using, in fact, gone way past them, and gone down to, say, 158.56 or below. That was about where our break-even point was. Beyond that, we would start losing against our capital. And my expectation was we would have, even if things had gone extremely bad and there was a pretty low risk of that happening, the probability of it doing that big of a gap and moving way, way down like that was low. If that had happened and it got way out of hand, we probably would have been able to still manage to minimize the loss to about a 30 to 40% loss in the trade, which is actually less than the profit that I expect to see tomorrow morning. Now, theoretically, the max risk would have been the full price of the trade, which was about $5,800. But that is, it would have taken an extreme situation like 20-30% jump or drop down in the price of the stock to us actually achieve that full loss like that. It would be unlikely to happen. So overall, I think we're in great shape. I think we're looking at a good possibility for making some money. The trade is working exactly the way it's supposed to work, and knock on wood, we've already got a profit target out there for tomorrow morning when the market opens up. If we hit $1.68, we are walking away with a great profit. We'll see. I'll tell you what the answer is tomorrow. But I think from my point of view, I could just tell you to short this, buy this, have a stop loss here and a profit target here. And I could fire that trade off, and bluntly, it's really easy for me to do that. I can do them left and right, and most of them will be decent. Handful won't be, but you're not going to get anything from that. You're not going to actually learn anything. We still got the trade, and Rob was there to do it, but we also took a lot of time to understand exactly how and why it worked, how it fit together, what were the choices, and why. When I'm gone, or when you no longer want to come here, you'll be able to keep going with that and do the same thing in the future. So there you go. That is why I believe that is important. Any questions on that stuff? I mean, I think that learning and understanding the trades is very critical. The other thing is this: if you don't understand what you're doing and understand why the trade should work and what was the reason for taking the trade, you'll never know when the market changes and you shouldn't take the trade anymore. So that's another piece of it. And Rob, yeah, I think there's a pretty darn good chance that we're going to be making money tomorrow. So all good there. All right, building the strategy. Once we've identified the opportunity, the next step is to build the strategy, or to use a tactic to basically turn the opportunity into a profit. And this is another piece that you really need to understand. There's a lot going on here. We talked a lot about the Greeks. What we're going to partially talk about today is how you use the Greeks to basically enhance trades in different ways, and actually turn them into trades that do multiple things for you. Now, if we believe a stock is going up, it's easy. We can throw a bull put spread on it. But is that actually the best opportunity for that trade? Is it the best way to make money for that trade? There's actually a lot of other ways to make money on a trade. There's a lot of other trades that we can do. Bull put spread is a bullish trade. It's got long delta. It's short volatility. We would lose money if implied volatility spiked up. On the other hand, we might want to shift over to a different style of trade called a calendar trade and do a bull call calendar. You want to build your kind of skill set of different tactics. And don't get caught up in the idea that it's 2 or 3 things that you've got to be really amazingly good at to, and then you'll be successful. The thing that you want to be amazingly good at and work on continuously is understanding what's going to happen next to the market. The next thing you want to be good at is picking out the right style of trade and the right tactic to turn that into money as safely as possible, as controlled as possible, and ideally maximize the profitability as much as possible. The earnings trade that we took on IBM, it was designed around that idea. It's very specifically designed. The strategy is there for a number of reasons. I could have put an iron condor on it. I could have used a really high implied volatility to create an iron condor, which has a pretty good probability of success, and then capture some money as it goes down. Problem is, that strategy is really at risk if we have an exceptionally large gap. And when it fails, it blows up on you really bad. I could do a butterfly. Well, it's actually just a modification of the iron condor. I could do half a dozen different things. But the smart thing to do is to use a combination of the volatility that we're doing on that trade and the probable price movement in combination and create a trade that actually works very well with a lot of control, which is why I can pretty confidently say that tomorrow, even if that IBM trade did something really weird, I should be able to manage the risk to take less than a 40% loss. I won't be able to do that every single time, but I can pretty much say that historically I've done it time and time again and controlled the losses quite a bit. It's because the trade's designed to work that way. So we're going to build out your tools and your strategies and your tactics so that you can apply them to opportunities and turn them into money for yourself. I really don't like when people just arbitrarily take the same trade over and over and over again. It implies that you're not thinking about it and basically is setting you up for a really bad, risky situation. Taking the time to identify each trade's risks, rewards, and probability. This is another intellectual exercise that actually benefits you a lot because it introduces a little discipline into your trading. We need to realize that options trades aren't simple trades. So we need to build out a little bit of an idea of what is going to happen as time passes, what's going to happen if the implied volatility changes, what's going to happen if a specific risk pops up. So as part of your trade plan and as you're building out your trades, you should be thinking about these things and keeping some notes. It doesn't have to be horrendously complex, just a little bit of an idea of you think that this is going to happen, this is going to happen, this is going to happen around the risk, rewards, and probability. What's my probability of success? What is the amount of money that I would make if I was successful? What are the risks that could come along and derail that? Not to paraphrase Rumsfeld, but he did say something that was actually really important to help you think about things. This was back when he was defense secretary, and he was talking about we've got known unknowns, we've got unknown unknowns, and we've got known knowns. Things that we know, things that we know are out there, but we don't know what their answer is, and we've got the unknown unknowns. Well, 2 of those we can pretty clearly mark down, and the third one we can speculate on. Get in the habit of doing that, making some notes about it, and practice getting better at that. One of the things that you should do as you're reviewing your trades after a period of time is ask yourself, could I have known, looking at a trade, seeing what risk came along and caused the trade to fail. Ask yourself, could I have known that risk was out there? If I had put a little more effort in and paid attention more or did a bit more research, could I have known that risk was going to derail my trade? Now, you're not supposed to do that to beat yourself up. You're supposed to do that to learn and become better and better at your trading as you go. It's a growing educational learning process. And you're never going to be perfect at it. I'm not perfect at it after my 20 some odd years in this damned industry. I'm getting burned out at this point, but I'm not done. I am constantly learning. I actually had somebody surprise me with something the other day. I was very pleasantly surprised. I was talking to somebody I was doing some coaching with, and they brought up this idea that they had thought about and had heard from another place. We dug into it. I would have immediately said no, it was a bad idea. I learned something, and I learned a new way to make money in the market. That's what we want to do, is we want to take these things that we're doing, make them obvious and specific, trade, and then review our process and review our performance so that we can learn from them and be better. And especially around risks, because I find that a lot of people get fairly lazy about risks. Looks like a good trade, let's take it. Yeah, there's an 18-wheeler heading for us. Didn't realize that. This might hurt. Now, getting into trading itself and kind of a more of a mechanical thing. When you're trading, you need to be aware that every single trade you take has a risk. And I'm talking a real present risk. Everything you do can fail. There is no trade out there that has no risk, except in arbitrage, and those really don't make you much money, and they're not very easy to do. So you need to figure out ways to manage your risks. One of the things that I see new traders doing a lot, and I think is a real big mistake, and I want you to avoid this, is going into it thinking, I am going to start out small. I'm only going to do 1 or 2 trades at a time. Now, if you were really disciplined and took all of those trades as really small trades and only a small, tiny portion of your portfolio, that could be an approach that could be usable. But most people, when they think, I'm going to start out small, I'm going to do this safe, and I'm going to do this, a little bit at a time, dip my toes in, they say, how much money do I have in my portfolio? Okay, I'm going to put this trade on. Well, I've got this much money to do it. They put all of their money into one trade, or a huge amount of their money. Maybe it's half their money. That's still way too much. The reality is we're never going to be right about every trade. And some trades we take can actually fail quite painfully. To avoid that pain and to minimize it, and also give us the greatest opportunity to actually be successful at our overall trading, we need to diversify. Diversification is the cheapest way to minimize your risks and reduce your overall risks in your portfolio. It is a brilliant tool. The greatest thing about diversification is it reduces your risks without technically costing you anything, or not much anyhow. If you hedge, if I buy a long put, buy a long call, whatever, to protect my portfolio, I'm spending money. In fact, you'd be surprised at how much money you are spending to make a hedge like that work. And most likely, you're not going to get much of it back. So that right there is basically an expense. You are reducing the risk in your portfolio, but at the same time, you are spending money to do it. You're spending some of your profits to make those risks go away. There's times when that makes sense. But in general, what you would rather do is figure out a way to reduce your risks without spending a bunch of money. And by the way, we're going to really get into this in a few minutes. Diversification is the simplest and easiest way to do that. And it works in every market. You can diversify in the stock market. You can diversify in Forex. You can diversify in bonds. You can diversify in options. Basically, we are not putting all of our money on black. We're going to break it up into smaller pieces. In a few minutes, I'm going to actually show you one of the approaches I use for sizing my trades appropriately for my account and diversifying. Now, the diversifying is, first of all, choosing symbols or stocks that you're trading, your underlying symbols that are different from each other. And you really need to pay attention to that, because a lot of the stock symbols are not different from each other. The broad market goes up, they go up. All right, that's great. Now, if I took 2 of those, the broad market goes up, both of them go up. Broad market goes down, dang it, both of them failed at the same time. I am not diversified. So you want to think about things that allow you to be diversified. Things like finding symbols that are not highly correlated with the market, using those as the basis of some of your trades. Finding symbols that react in different ways to the market. There are some things that react to oil prices, there's some things that react to inflation, some things that react to broad economic health and growth. Other things are completely independent on reacting to how much natural gas somebody's pulling out of the ground. You want to find different symbols to spread out your ideas and your trades on so that they don't all fail for the exact same reason at the same time. Now, to do that effectively, you have to have a way of allocating money to each different trade so that you can actually put the right amounts of money and balance things out. I have a fairly simple system. It takes a little bit of math. Simple calculator will do it, and you can do it in a matter of 2 minutes. But I'll show you that approach and basically give you that so that you can try it out on your own portfolio. I allocate my trades by risk. All right, so here's the basic idea. We'll do this hands-on in a few minutes when we're actually looking at some trades. For most of the portfolios that I do for educational classes, we're using a standard $100,000 portfolio. Now, I realize that people have wildly different sized portfolios. I know a lot of people that work with me have radically larger portfolios than that. Many, many multiples of that. I also know that a large number of people have much, much smaller portfolios than that. What we're doing doesn't really matter the size of the portfolio. If you've got $500 in a portfolio, I'm sorry, it's going to be a little challenging to make options work for you. But if you've got, I'm not even talking a lot more than that. If you've got a reasonable amount of money, bigger than that, you can certainly trade options just as well as anything else. What we need to do is have a universal system for figuring out how many contracts of each trade you should take. So the way I look at it is this. Every trade I take should have an assessment of failure risk. Now, what is a failure risk? Well, here, let me explain it. Now, I'll put it in terms of the trade that we were just looking at. And Rob, this one's great. Look at this. We're settling right in at about we're about 163 right now. That just drops down just a little bit more down to the 162.50 range. We're in awesome shape tomorrow morning when this opens up. So knock on wood. Now, let's actually look at this trade. So ignore the size of this trade right now. In fact, it's wrong for this account. Thinkorswim's doing some weird stuff with me. When I created my trade, I knew some basic things about it. Things like what was the max amount of money I could lose on a single position. So let's take a look at that. I believe I got into this trade for, hold on, what was it? Just a second here. All right. $1.10. So we put this trade on for $1.10. Now, when I set this up, I know some basics about the trade. This is a debit trade, and just due to its nature, our max risk on this trade is equal to the amount of money we spend on it. Now, a credit would actually have a slightly different calculation, but in this case, the margin or the cost, whatever you want to call it, is based on the debit of the trade. We have $1.10. All right, so absolutely worst case scenario, I would lose every single cent of that if I was an inattentive idiot who did not pay attention to my trades at all and just let this go way out of hand and let it expire. Hopefully I'm not that person. 1.12, what's that? $1.12. Okay, yeah, good. I had a couple of different trades in there. So I know that the cost of the trade, we'll go with $1.12 as Rob said, and I know the cost of the trade was $1.12. Now, that equals 100 underlying stocks, so 100 times $1.12 is basically $112. I know that the maximum amount I could possibly lose on that is all of it. I could go to zero. Now, this is where a bit of judgment has to come into play. And as experience goes, you'll figure this out a little bit more. If this was a trade that I could use a stop loss on or kind of a managed exit point, I would absolutely do that. Most cases, I would probably be putting about a 40% stop loss on this. Well, I need to be realistic. This is not a trade that a stop loss is going to work, because if for some reason IBM gaps even further down and goes all the way down to 40, I don't have a moment of time to trade it, to close it, as it passes my stop loss. So I need to take that into account. But I do know from experience that on average, these trades do not have radically bad losses. And even the worst ones, I can normally limit the max loss to about a 40% loss. So that gives me something to work from. I can look at this and say a realistic risk assessment of this is, if I were to be in a normal, average, bad situation, failure on this, what is the level that I should be able to limit the risk to? Well, in my case, I believe it's 40%. So what would a 40% loss on $112 be? I have $112. This is one of these times 0.4, $44.80. All right, we're just going to round that up to $45. All right, we have one of the numbers that we need to make this judgment call about the size of the trade. Second part is this, and this is very personalized for you. How much money do you have in your portfolio that you consider risk capital assigned to options trading? Well, in my case, I have a $100,000 portfolio, but this process will actually work perfectly fine no matter what size portfolio you have. Like I said, as long as it's more than $500, you're going to need a little bit more than that, but in general, we can make things work. So I have a $100,000 portfolio. Over time, I have determined that based on my style of trading in general and the general approaches I take and everything else, about 2.5% allocation of risk per trade works out fairly well for me. It's about the right size. Now, if you wanted to, you could be allocating more. If you allocate more amount of money, more percentage of your portfolio to a trade, what you're doing is you're exposing yourself to the risk of a greater swing up or down. The portfolio will be affected more by the size of the swing if you allocate more risk to these. If you allocate less, you are going to have smaller trades and you're going to have even more diversified portfolio. 2.5% gets me to about the right level for me. If I have, on my style of trades, about 2.5% of my total portfolio allocated to each trade, then it normally allows me to get to somewhere between 8 to 16 trades at once. Now, an average size is probably about 10 to 12 trades. And by the way, 10 to 12 trades is a very, very good level of diversification. It reduces your overall risk a lot. It gets you to the point where you've got a good, solid, broad diversification, and it doesn't make you go nuts trying to manage 50 trades at once, which is really hard to do. So 2.5% works for me. So 2.5% of $100,000 is $2,500. So, by the way, remember $45, $2,500. Now, if I were to lose $45 on each of these, if I hit my 40% stop loss, I could take 55 of these and the size of the trade would be perfectly fine. Now, the nice thing is this, if you use this basic process, this step-by-step idea of just determining your risk level and the amount of the size of the trade, it keeps all of your trades relatively similar to each other in your portfolio risk-wise. You know, as long as you're not using radically different approaches to figuring out what your risk level is on every trade, what you're going to find is that every trade you take is roughly the same risk overall. And so you've got some trades that are high probability trades that might have some big max risk, but overall this sizes it right for you. Those can work. You've got other trades. You've got your earnings trades. Everything has a place in the portfolio, and it's kind of balanced out. You're not overly at risk for one particular trade working. Everything is working together. Now, does anybody have any questions on that general step-by-step procedure? Step one, figure out what a reasonable risk metric or risk level is for the trade. And you're looking at that in terms of one individual trade. That could be one of each contract, could be one butterfly, could be a number of things. But for one unit of a trade, how much risk dollar-wise do you believe that that trade has, based on the idea that you're going to manage it and close it? All right, so there you go. You have the number. That's the risk for one. How much is your portfolio, and how much are you going to allocate to each symbol? Well, in my case, 2.5% times 100,000, $2,500. So if I have $2,500 to allocate, this trade has $45 worth of risk. I do the calculations. It means 55 contracts. Boom. I have my trade. That's the size of my trade. Does anybody have any questions? Any thoughts? Okay, moving on. When I close out of the 40% stop loss, do you take the bid? Okay, no, never. Slap your wrist. Well, actually, I'm going to be careful. Maybe if I absolutely had to. Actually, Jen, thank you for saying that, because it gives me a good opportunity to talk about something. In the options market, if we ever say the word stop loss, it's mostly so people understand the concept we're talking about. Please don't ever use an actual stop loss order in the options market. Or you can if you want, but John, sorry. JL is, I keep getting those flipped around, but John, yes. You two have two close initials, so just flipped around. In the options market, there's a big problem. Bid-ask spreads are very, very wide. And options stop losses put out in a market order that goes and gets each leg of your options trade filled at either the worst case bid or the worst case ask, depending on whether it's a short or a long trade or a short or a long leg. That right there creates so much slippage in the trade that you can actually lose more money from a stop loss order being executed than you had as a max risk on the trade itself. That's how bad it can be. So under all situations, avoid using a stop loss order itself. It just doesn't work in the options market. There are alternatives that do work. Some of the alternatives that do work are things like stop limit orders. And that's where you have a price that you're targeting as a bid-ask midpoint price. And when that price is hit, then your system issues a limit order with a little bit of an aggressive price to exit. Not a stop loss order, not a market order, but a limit order with a very, very good price based on that market price that should get you out nice and quick. That means you're going to give up a little bit of money, but not any kind of outrageous amount. And that's a very common order. Most of the time when I'm doing this, I actually send an alert to myself way before I get to my point where I am hitting that, what I would call a risk exit. And I am waking myself up and manually exiting and managing the trade that way. There's a lot of different things that you can do, and you'll build up more and more techniques as you go. But I'd say those are probably your basics. If you want to have it automated and you don't want to have to be there, look at the idea behind a stop limit order. If you are going to be there, set up alerts on your trades to give you a warning. So in this case, if my stop loss was at 55 cents as the option price is coming down closer and closer to that, at say 65 cents, it would issue an alert, send a text message to my phone, pop up an email, say, hey, Doug, pay attention to this. It would get my attention and I could close it out before it got to its target price. So those are some things to do. Actually, Lou, I would say this rate here, right off the top of my head, don't do iron condors in SPX. If you're going to do stop losses and you're going to be doing trades on iron condors in SPX, which is the S&P index, shift over and start doing the same trades in SPY. Now, there's some good things and some bad things. First of all, the bad thing is that the size of the price of the stock, or the symbol, the ETF SPY, is less 1/10 of SPX. So that means that you end up having to take a greater number of contracts to make the trade work. Now, that is an obvious and true negative. But you more than make up for it with the fact that SPY's bid-ask spread is about 1 cent. And the slippage on it is almost non-existent. The liquidity on SPY options is outstanding. You can get in and out extremely fast. There's a ton of really good reasons why you would want to do that. I basically do not trade SPX at all anymore. Over the years, I got so fed up and frustrated with it that I walk away. The other thing is that SPX, you may or may not know this, I don't know, but your brokerage is likely charging you a surcharge on your SPX trades that is not necessarily directly tied to the SPX trade itself. You're not seeing it as a commission or anything like that. It just comes up as a market surcharge at the end of your bill. Most people don't realize that the exchange for SPX is totally different from the exchange for most other options, and there is a very large fee that goes with trading on that. The brokerage passes that rate through. So a lot of the advantage you get from having fewer contracts, you give up by paying that fee. The final thing is there's theoretically an advantage using SPX when it comes to taxes, but I have almost never seen anybody actually get a chance to use that theoretical advantage. There's a different tax treatment for SPX options versus SPY options, or any other options, to be honest with you. You're allocated a certain portion of the profits as long-term capital gains, and the other portion of the profits as short-term capital gains. Normally, you're dealing purely with short-term capital gains. Now, that all sounds well and good, except for the fact that if you take your taxes down to H&R Block or Jackson Hewitt or any of those people, they will be 100% clueless on how to actually get that for you. It involves a whole bunch of additional paperwork. It involves a bunch of actually quite expensive things to have your tax person do. Usually they charge you per paper filing. So you get charged a bunch of things to hopefully get a little bit of an advantage in taxes. And most of the time I find that, and by the way, the IRS isn't going to come and say, oh, you missed a deduction. Most of the time I find that unless you are using a professional trader tax firm, and by the way, if anyone's looking for one, highly recommend a group called Green Trader Tax. Just look them up online. They're very, very good. Unless you're using a professional trader tax company, you're not likely to get the advantages. So a couple things to think about there. Everything you can do on SPX, you can do on SPY just as easily. And use the same ideas, same rules, just different target. Yep. You will spend a little bit more on commissions, but you save on those extra fees. And what I've found is that really you almost come out with exactly the same. You know, the cost-wise, it's not that different. Because, you know, you're still getting the extra fees. You're still getting the extra fees on SPX. You're not seeing them with you get charged a lot extra for that one. And by the time you get done with everything, you come out pretty much the same with SPX and SPY. But SPY is way easier to trade. Lou, is it realistic to target a 1% weekly return with the different tactics? I think it's realistic to head in that direction. If you want to be more aggressive overall, yes, you can do that. It really depends. I know that in general, I'm usually hitting somewhere between a 20 to 35% return a year in general. And I've got a pretty good track record of that over, many years. And I feel pretty good about that. I'm happy with that. I could go for more, and I could probably be more aggressive, and I could probably make more money. But you need to realize that by doing that, you expose yourself to a higher risk of loss. Whenever you go for more, what ends up happening is you create a greater amount of variance in your portfolio. The swings up and swings down tend to be, faster and larger. So where do you end up in the long run? It's hard to say. Could you make 50% a year or 52% a year? Yeah, it is definitely possible to hit that. And I've seen people even do much better than that. But the more aggressive you get, the larger the payout you're looking for, the more risk you take that you're going to take a bigger swing down when things do fail. So just balance that out in your head. Are you happier being consistent and having a nice regular income over a period of time, or do you want to go for the bigger money? It's your choice. Just understand the trade-off that comes with that. All right, let's keep going on this stuff. Now, this is probably just a little side comment, but I've talked a little bit about what should go into the thoughts behind trade planning. And by the way, every trade you really want to be thinking about what is your approach to getting out? What is your approach to managing a failure? How is it going to fail? What am I going to do in the case when it does fail? All of those different things. And as we get into different tactics, we'll dive into ideas on how to manage the risks around each individual tactic. But you also have to realize something about plans. And I think I come at it from a very, very different angle from a lot of other people that teach out there, because I usually get some weird reactions when I say this. Planning is an incredibly good thing to do. It's an excellent process. It gives you a lot of benefits. It forces you to think. It forces you to have a process in doing your trades so that you make sure you do them well. It makes you think through how are you going to execute the entry, the exits, the profits, the risk exits and things along those lines. But you make a plan as you're entering the trade, and you have very little idea of what's actually going to happen in the future. One of the first things I ever do, and if I've got a plan with a bunch of triggers in it, if this happens, then do this. If this happens, then do this. The first thing I do when I hit one of those triggers is ask myself, is the plan I made in the beginning, does this really make sense? Does it apply to the situation I'm actually in right now? I like to switch this around a little bit. Every time I hit one of these triggers, I know what my initial thought process is. I know what my reason for doing the trade, for those entries and exits are, and what I was thinking about. But I like to reevaluate the trade as if I was entering the trade again right now. So if I were, I'm in the trade. I have the trade in front of me, and I'm at a point where I need to make a decision about the trade. I think one of the most helpful ways of thinking about it is stop. Forget about the fact that you've even been in this trade, and reevaluate the trade that you've got in front of you as if it was brand new. Would you take that trade right then at that moment? Now, what this does is it forces your brain to think about things in the same way that you thought about them when you entered. Do I have enough opportunity going forward to take this trade? Is the risk appropriate? Is the opportunity I'm going after, am I using the right trade for it? All of these things, you're assessing all of these. And the end result should be, yes, I would use my money to put it into the trade that's right now that I have, and I would like to make money using this trade. Or, no, this is inappropriate. This is a bad tactic, or this is a bad approach to making this opportunity work. Or in a lot of cases, when you're hitting a spot in your trade where you're assessing a risk or assessing a trade failing, you don't know what's going on anymore. When something suddenly changes, the one thing I can tell you is you should be less certain about what's going to happen next. When you get into a trade, it's because you're confident that you know something. When a trade fails, the trade effectively is telling you that you were wrong and you shouldn't have been so confident. You need to stop and realize that you don't have as much understanding of the situation as you thought you did. Well, if that's the case, get out of the trade. Walk away. Close it. I see a lot of people digging into ideas like repair strategies, adjustments, things like that. Now, I'm not against adjustments, especially if they're for creating additional profits in trades. I think those are great. I rarely do adjustments or repair strategies when a trade fails, because what we have at those moments in time is a situation where I have just been proven that I do not understand what was going on in the stock. If I understood it and expected this to happen in the stock, then I wouldn't have put the trade on and I wouldn't be failing right now. So I am walking into this situation knowing that I must not know something important. Is that a good time to put more money into that situation and try to make a bigger profit off of it? No, it's a terrible time to do that. It's the worst possible decision you can make. We make money by making smart decisions based on our knowledge and understanding of the situation. If we have a less understandable situation, we have a higher level of risks and we make less money, or we lose more money. So, in general, if I'm ever in a situation where I'm looking to adjust a trade, repair a trade, fix a trade, or I'm even questioning, I've hit a trigger that says, hey, you need to pay attention to this because we're getting to a very risky point, I need to stop and I need to look at this and say, do I really understand what's going on? Do I believe that I know what's going to happen next? And is the trade that I'm in right now the right trade to turn that into a profit? If any of those turn out to be no, the correct answer is shut the trade down and walk away. The nice thing about that is you can take the money that you just retrieved by closing the trade down, minimizing your losses, exerting control over your trading, and you can turn that money into a brand new trade on a symbol that you are more comfortable about, that you are more confident about. This is something that trips up traders left and right, because what they want to do is they want to win on a trade. They want their trade to win, and they think that's how they make money. Well, partially it's true, but it's not really the big picture. The big picture is that we want to be using our money overall, our portfolio of money, to generate profits using a wide variety of different tools that all in general are generating us a nice net profit. Any one of those tools isn't working right now? Well, the best thing to do is stop using that particular tool and find a better tool to use. When you focus on trying to fix, repair, magically make a trade better, you're closing a bad trade and you're putting on a brand new trade with a whole series of risks, rewards, probabilities, everything, just like you had in the beginning. But in this time, you're doing it on a symbol that just proved to you you don't understand what's going on. I would rather walk away with my money and find the best place in the market to put my money to use to make profits, basically recover my losses. So think about that. Now, getting back to the plan, when we evaluate a trade based on the ideas of, is it a good idea to be in this position? We can just evaluate whether or not the original plan we had was a good plan. Now, things might have changed and made the original plan a bad idea right now. It gives me a moment to reassess things. Now, you need to balance this off because you can't be too wishy-washy. You can't be sitting there saying, I'm hoping that this trade is going to recover. I'm hoping that things are going to get better, or it's pulled this, it's changed its direction from this nice clean trend up to a quick pullback down, but obviously it's going to go right back up. Well, that's not really knowledge. That's called hope or wishful thinking, magical thinking. And that is not helpful. You need to avoid that. You need to have something to control that. What I'm talking about, though, is actually assessing a different condition in the market and saying, well, my original plan said to do this, but the world has changed in this way, this way, and this way, and the smarter thing for me to do is this. Use those as opportunities to make more money and increase the profitability of your trading. Also, use them to evaluate your own skills, figure out whether or not you're making good decisions or bad, and improve your thinking a little bit. Now, those are some of the basics. Anybody have any questions on the basic concepts we just covered? The simple stuff. No? Any thoughts, comments? Quick question, does this actually make sense? Hopefully, these are things that took me a long time to learn. And a lot of this was driven into my head over the years from a lot of pain. Hopefully you can get these ideas and think in that direction as you're trading from the beginning and actually just develop them as habits as opposed to figuring out that other things don't work as well. So that's what I want you to avoid. This next step. Oh yeah. Hope is an expensive emotion. It's an extremely expensive emotion. Hope will kill you. Man, it will absolutely kill you. It's the thing. That's the thing that says. And actually, let me flip that around a little bit. It's a combination of unrealistic hope combined with this hatred and fear of failure. One of the things that will actually help you in that situation is stop hating your failures. It's part of the trade. It's part of the process. A failure is not a horrible trade. Every single trade we take has a probability of a failure. And that is not because we made a bad choice. It's because the reality is that the market does things we can't control. And it will always do things we can't control. That's built into our trading. Luckily with options, a lot of our trading is around the probability of those things happening, and we can make choices around that. But accept bad trades. They're fine. They're perfectly fine. As long as you've sized them properly, as long as you're well diversified, you can have a couple of bad trades while the rest of your portfolio is working for you. That is how things should work. If you hate trades that fail, and none of it, it's never fun. You try to fix things. And when you're fixing things, you're usually creating a greater problem. You're not fixing things, you're plastering over a problem that is still there, trying to make it look better. So, embrace the failures. Don't go after them, but embrace them and understand them and live with them, and that's fine. And avoid hopeful thinking. Try to make good logical decisions based on information, not on wish. Yep, hope and opinions. You want to know something that is statistically very, very true and nobody ever seems to believe? You know what the most likely thing that a stock is going to do tomorrow? Pretty much the same thing it did today. That's the most likely, highest probability situation. I'm not saying it's going to go exactly up 1%, but if it was a moderately bullish day today, it is probably going to be a moderately bullish day tomorrow, statistically. And that is an actual measurable, provable effect in the market. Now, it doesn't mean that every day is going to be the duplicate of yesterday. Obviously, we have things change around and shift around. But most of the time, your better bet is just following what has been happening. But so many traders seem to have this idea that they want to pick the big change that's going to happen next because they can make the big money that way. The market's going to reverse. It was heading up, and on Thursday it's going to go down. You know how hard it is to be right on that? Focus on trades where you don't have to work so hard to be right. Focus on situations that are simple, understandable, not working on some convoluted logic based on squiggle line this and squiggle line that, just basic things going on in the market. If you've got situations that are not understandable and chaotic, avoid them. I always have somebody, OPEC just cut production by 30%. Should we do a trade on this? It's like, oh my God. First of all, when has OPEC ever actually followed through on anything they said they were going to do? That's top of the line. Number two, do we really understand how the market's going to react to this and if they're going to believe it or not believe it? No. And number three, we just created a situation where volatility is even higher and less predictable. Heck no, I'm staying right away from that. I'm going over to this nice, boring symbol that's been trudging along in the same way for the last year. That's a nice, comfortable, easy trade. I like easy money. I don't like working. So now, a couple of things about trading, and we're going to get into the portfolio side of things. Making money is hard, absolutely. Keeping money is harder. It's almost more important to keep your money in your pocket than it is to put out a huge amount of effort and work super hard at making the money. I know this sounds a little backwards, but what ends up happening is the greater the magnitude of the losses you have, the more work you have to work, the more effort you have to put in on getting back up. A big loss takes a lot more effort to get up percentage-wise than the loss itself took getting down. Climbing out of those holes is harder and harder and harder. So if we want good, consistent, long-term results, don't focus every effort on making the big win. Put a lot of effort into managing the system so that it doesn't have big losses. That actually will end up being a very useful tool to you in the long run. A lot of benefits. Makes you more comfortable with trading. It puts you more in control. It gives you more consistent results. And basically, in the long run, you end up way ahead. So what are we doing with all of these little tidbits and snippets of knowledge that we just chatted about? I have, at least what I've experienced to be a generally different approach to trading. Now, it's not wildly different. It's not completely unique, and I'm not saying it's all mine. But it is a different thought process that I see from a lot of traders. Really would encourage you to stop trying to be so right, okay? Because there's a diminishing amount of return for the effort in that. You can put more and more effort into trying to be more and more and more right and not get any further ahead. While you're doing that, you're giving up the opportunity to put time and effort into being more in control. So, as opposed to the idea that I want to make a perfect trade, what I want to do isn't winning trades. I want to focus on what really matters to me. I want to have more money in my account at the end of the month than I have in the beginning of the month. And this is where things get very important. This is really where people's ideas change too. Because most people want to win a big trade. And that's what they'll brag about. You know, look how much money I made on this. In reality, what you want is to have more money in your account so that you can buy more stuff, pay for those vacations, buy food, have a retirement account, go to the islands. I don't know, whatever drives you forward. A lot of times they put so much effort in wrong places trying to fix that perfect trade that they're actually hurting themselves in their bigger goal, which is to make money. The other thing we have to realize is no matter how much we work at a specific trade, we always have the chance that the trade is going to fail. Every single trade has a built-in probability that it could fail. Now, I don't know what's going to cause it. I don't know why, but out of the blue, something could happen. Big rock falls from the sky. Somebody we didn't expect gets elected to president. I don't know. It doesn't matter what it is, but every trade has a risk of failure. So let's build a portfolio that's designed around the idea of managing failure and design it so we can make money, but at the same time reduce the effect of failure on the portfolio in general. So portfolio trading, this is the piece we're going to get into next. We're going to use the basic concepts of long-short hedge funds modified to work in the options market. We're going to focus on diversifying our trade targets and strategies. We're going to mindfully and a very aware choose each trade based on the core fundamental strategies and a very strong focus to reduce our overall risk in the portfolio. So let's hit these topics one by one and let me explain what they mean. First of all, who here is familiar with long-short hedge funds? Ever heard of the concept? John, okay. Little John, there we go. Andrea, good. Anybody not heard of them? Only from me. Okay. You know what, Rob? They're a huge part of the market, a massive, massive industry. Um, they are the hedge funds that basically cater to Andrea, no, absolutely not. That is not what it means. Um, I would definitely say that is a poor definition of what a long-short hedge fund is. Let me run down through the basic concept. A long-short hedge fund is generally using a fairly straightforward strategy where they are using stock investments, just like a mutual fund or hedge fund that might not be using the long-short approach. But they're using stocks to make money. Now, instead of just picking out a bunch of investments that they all believe are going to go up and they're going to be good, they take a little bit more thoughtful approach to building out the portfolio of their hedge fund. They take a portion of their trades and they focus them on bullish trades. Companies they believe are going to grow for whatever the reasons. It doesn't matter what the reason is. Whatever they feel is right, there's opportunity they see in the market, they're going to put a certain portion of their portfolio into a diverse section of trades that are bullish trades. Okay. They take another portion of their portfolio and they actively seek out what they believe as failing companies, dropping prices, companies under pressure, things like that, failing trades, bearish situations. And they basically build out half of the portfolio or a portion of the portfolio on those bearish situations. Now, that creates an interesting balance. When the market is just doing its normal thing, each of the individual trades that you chose produce good results. If you're generally right, they're adding to the portfolio's value and you're making money in both directions generally. The bullish trades are making bullish money, bearish trades are making bearish money. Everything's wonderful. You're very, very happy. But when the market suddenly does a big change, and honestly, this could be a change in any direction. It could be shooting up or it could be collapsing down and correcting. What happens is the bullish trades are not performing well. In fact, they're probably losing. But the bearish trades during the correction are doing exceptionally well. Now, it doesn't mean that the portfolio will not lose money, but what you've done is you've created a balance effect where all of these trades taken together mean that the portfolio, the long-short hedge fund, walks away from this with a much smaller loss in their portfolio than they would have taken if they'd all been focused on just bullish everything, which is what a lot of hedge funds do. It's just long everything. Yeah, it's impossible to make something so that it doesn't lose money at all. But using that general approach, they can reduce the effect of market failures and market changes on the portfolio. Now, what they're trying to do is they're trying to hit some benchmarks. They're normally trying to hit about 80% of the profitability of the market. So if a market goes up 10% in a year, they're actually shooting for closer to about 8%. And at the same time, they're trying to shoot for roughly half of the risk metric or half of the risk that the broad market has. So if in that same year the market had gone down 10%, theoretically their goal would have been to limit their losses to 5%. That risk-adjusted return ends up being a pretty powerful thing. And they sell their ability to do that to big, huge pension funds and things along those lines. Big business. Now, we're not trying to be a long-short hedge fund, but we are using the concepts. So what do? All right. We build out a portfolio of trades. We already know that we need to diversify. I already talked about the fact that we need to have different symbols that we're using as targets because we don't want all of our trades to fail at the same time in the same way. But we also want to be very aware of some other basic things. We talked about the Greeks yesterday. The Greeks are a big part of this. For every trade you take, you can run a really quick little calculation and find out how much you're long delta. So basically, If the stock market were to go up, is the symbol you're in going to make money, or are you short delta, which means it would lose money if the stock went up? If the stock went down, a short delta trade would make money and a long delta trade would lose money in general. You can calculate your overall exposure to delta across your entire portfolio. You can even do some neat little tricks. It's called beta weighting, and you can say that if the broad market went up by 1%, this stock would go up by X number of dollars. And you can use that to figure out where your risks are. Overall, are you risky in your options portfolio if the stocks all suddenly start going up? Well, if you're very, very bearish and you have every trade as a bearish direction trade, you are going to be at risk if the whole market shoots up. Same thing if you are bullish across everything. Let's say I had an entire portfolio of bull put spreads. And this is something that happens to a lot of people because they get taught one trade and they continuously do it over and over and over and over. And they don't realize that even though that individual trade may be a good trade, adding another one of those trades on is a bad idea. They concentrate all of their risk in one specific direction, and then suddenly something changes, and you don't just fail a little bit, you fail a lot. Everything's failing on you at the same time. It's failing on you in a big way. You're scrambling to kind of limit your losses to your stop losses. Instead of just having one or two of your portfolio failing, you've got a bunch of your portfolio failing, and you are in pain, and it sucks. And you've just lost a bunch of money, and now you're in that position where you're crawling back out of the hole. And that's never good. With a little bit of a different approach and kind of using some of the general ideas of long-short hedge fund, we can fix that. Now, let's be real. There is no way to make a risk-free portfolio, or you just can't do it. You can't make risks completely go away. But we can certainly design portfolios to be a much better portfolio and actually weather the storm very, very well. And it's not that hard to do. It's just being a little aware of overall, are you bullish in the market? Are you bearish in the market? There's another thing you have to be aware of. Are you short volatility or are you long volatility? Now, we talked about theta the other day. Theta doesn't really matter much in this case. It really comes down to delta and vega. Are you long volatility or are you short volatility? Are you long the market or are you short the market? The nice thing about theta is I have never seen any example of a crisis in the world that made time act differently. One day from now is always going to be one day from now. Therefore, I really don't need to put a lot of effort into hedging that off. It's probably going to happen whether I like it or not. Yeah, John, can I comment on delta neutral positions? Sure. Delta neutral positions are interesting. As a matter of fact, we use a lot of delta neutral positions. An iron condor typically starts off right off the bat as a delta neutral position. John, were you in my option strategist group the other day when we covered the IBM earnings trade? Okay, that was a delta neutral position, effectively. We were right in the middle of the everything, and really, in general, a movement up or a movement down was both going to have a positive effect on us. It wasn't completely neutral, but it was positive in all directions. That is still delta neutral. Delta neutral positions are all over the place. The problem is, and here's the reality, there's almost no way to make a completely 100% wide range delta neutral position and still have a trade that works. So delta neutral positions generally work in a certain way over a certain range. And then they start to either go against you very fast or you were going to lose in the middle of the range and you needed them to move a lot to actually generate a profit. Now, that's actually different from a delta neutral portfolio, which is an interesting idea. And this is what I really try to encourage people to work towards. And this is what we're going to experiment with in just a second. So a delta neutral portfolio is taking the idea of a delta neutral trade, which is hard to create one that works over a wide range, and not using the same stock to basically build the trade. You're actually using multiple trades with different aspects to build out the portfolio, which is delta neutral. So let's actually dig into this. So let's get off of the slides and focus on the trading platform for a few minutes. Now, I'm going to warn you, I'm going to do a bunch of different example trades. Now, I need to do these fairly quick. I have to be out of here by 6:30 at the latest. I can't spend a ton of time explaining all of the how would I make this trade work this way and this way and this way and this way, where would I put my stop losses, how would I size this. What I wanted you to get out of the next 45 minutes is these are the different types of trades and how you can use the combination of this type of a trade against this type of a trade to create a neutral portfolio of trades and how that can work to your advantage. And we'll explore that. Now, so if you want to mark down the names of the trades, whether it's a bullish call calendar versus a bear put spread, something like that, that's great. But I can't do the individual in-depth discussion of how to make every single one of those work. So let's dive in and take a look at some trades. So first of all, let's assume right off the bat that we have a situation where, I don't know, does anybody have a nice, highly traded stock that they believe is in a good, solid, bullish trend, or there's a good reason it's bullish, and it doesn't have an earnings announcement in the next week or so? Anybody have a symbol that they're following that they basically believe that about? Wix. Okay, let's take a look. Now, remember, sometimes when we're trading options, you do get limited by the type of, by the symbol you can use. If you're not in the really highly actively traded stocks, a lot of times the option series just isn't there. But let's see if Wix does have a decent option series. All right, first of all, we've only got monthly expirations. No big deal on that. We can still use it, but it's sometimes an indicator that it may not be the easiest thing to trade. Now, okay, yeah, here's the thing that I was worried about with that. Two things that I'm seeing right now. I would like to do a bull put spread on this. To do that, notice that I've got $5 spreads on a $54 stock. $5 is 10% of the price of the stock. That's a huge gap between your bid and the ask portion of a bull put spread. So that is probably not going to work. On top of that, you see this? I've got a 50-cent bid and a $1 ask. Okay, actually I should say the $5 was a very, very big gap between my short and my long portion of the trade. So that's one problem. The other thing is the bids and the asks of the options are enormously wide. Now, a lot of people ask me, do I pay attention to volume or open interest before, to determine whether or not I'm going to use an option series for my trades? I really don't. And the reason for that is they can be very, very deceiving. You'd think that something with a high open interest would give you a lot better chance of getting filled, and something with high volume would also give you a better chance of getting filled. It doesn't correlate to that very well. What it does correlate to, your chance of getting filled quickly, is how tight is the bid and the ask. 50 cents, I probably wouldn't take. Do we have another one out there? So I like, by the way, Rob, I think that you nailed the direction, and that is good. I really do like the overall trend that this thing is on, but the option series is a little tough to work with. TWIO. Okay, Lou, not an earnings trade. I just need a basic bullish trade right now. John, CLVS. Okay, let me see if that is workable. Clovis Oncology. Okay. Very, very high implied volatility. Let's see if it's tradable. Okay, monthly expirations. See, this is weird. See, I would probably get a bit nervous about this one too. See this, we've got a 50-cent bid by a $2.65 ask. Once again, direction is fine, but the tradability of the options are a little weak. By the way, a good place to look for options that are active and usable for trades, go to the CBOE Extended Weekly Options website. And I'll give that to you right here. This website. Yeah, 50 cents by 265, no problem with that at all. Yeah, Rob, that's exactly what you want to be thinking of is what, are those wide? Are they usable? Stay away from anything that's just irrationally wide. If you go to that website that I just gave you, like copy that and use it as a general reference periodically. The symbols on this page, down here, you've got a list of, let's see, these are ETFs, exchange-traded funds and exchange-traded notes. All of these have extended weekly options and tend to have a fairly high level of options activity on them. And these are generally ones that you can use pretty easily in trades. Now, these are the equities, same thing. This is just a fairly big list of symbols, and anything on this list should be, in general, a pretty decent symbol to work with for options trades. It doesn't always work perfectly, but this will filter out a big list of the ones that are not useful to you. Tell you what, let me just jump into one, see if I can do this real quick. By the way, this is one of the things I do on a regular basis. I've got this list of basically a watch list, and I just scan through looking for things that I am basically interested in, and that pretty well works. Schwab, probably not the best trade in the world, but let's see if we can make it work. Okay, these aren't perfect, but they're not bad. Here we are, we've got about a 15 to 20 delta, and I've got a 10-cent spread across something that's got a 45-cent bid. It's not perfect. I would like it better, but it's not horrible. I think that we'd actually be able to work with this. So that looks reasonable. Once we get down to the 10 deltas and start getting out here, this starts to get wide. I'm not really excited about those. But it could possibly work for us in general. Let me keep looking around and see if I can find something a bit better. Lots of things changing recently, by the way. I could probably go with this. Here we have Nike. Now, general story behind this one, Nike over the years have been an amazing stock, gone way, way up. It kind of got a little overbought and, slowing down a little bit, maturing, into kind of a longer-term mature company. Didn't see, it was a little pullback on its brands and things like that. Had some pullback. Kind of overshot a little bit, and now for at least the last couple of months, 2-3 months, we've been on a general bullish trend. I'd like to see this longer, but I think this is workable for right now. I could look at this and say to myself that I've got a reasonable expectation that this is going to be a bullish movement for the near term. Now, a couple of the things I'm looking at in this situation. One thing, I know that Nike has a very, very good chain of options that we should be able to get in and out of, no problem at all. 1-2 cent spreads, really easy to execute, lots of weekly options, lots of strikes, a very simple symbol to work with as far as options trades are concerned. Now, the other thing that I want to point out is the implied volatility is at about, it's near a midpoint or the middle range, lower end of a middle range of its own implied volatility. Now, why is that important? Well, I want to make sure that the trade I take is lined up on volatility. If I have got a option or a stock where its implied volatility is at the absolute bottom edge of its own range, I don't want to be taking a short volatility trade. I want to be taking a long volatility trade. In this case, I'm high enough that I can easily take a short volatility trade. That would be a vertical spread. So I'm going to do this as a bull put spread. Not going to be too crazy about this. I'm just going to use one of the weeklies expiring in 36 days. I'm going to go for about a 20 delta, and I am going to sell a 50 strike option that expires on February 24th. And I'm going to use $2 spread, and I'm going to buy a 48 strike put option expiring at the same time. Now, between the two, we are receiving a 22-cent credit on a $2 spread. Now, there's a couple other things that you should know about this trade. This right here is designed to be a bullish trade. If I took a look at my deltas, just like we did the other night, I've got 19 cents on a short option, or negative 19.2 on a short option. That's helping me. And I have a delta of 8.9 on a long option, or negative 8.9 cents on a long option, hurting me. Between the two, I have basically about a little over 10 cents of delta, positive delta in my trade. So that means if the stock were to go up by $1, I would capture about 10 cents worth of a profit in this particular trade. So this trade right here is a long bullish delta trade. And based on how I sized it, I would figure out what is my total dollar of delta that I'm going to get for a dollar, the total money of delta that I'm going to get for a $1 movement up. The second thing I know about this trade is that it is a short volatility trade. So I've got a short option here, and Vega is a positive number. So this is actually going to hurt my short option. For every 1% increase in implied volatility, I'm going to hurt my short option by about 4.6 cents. Okay? I have got a 48 strike that is a long option. Now this helps my long option. Positive number increases its value. That's what we want to see on a long. I am gaining 2.7 cents. All right, let's just assume that these are 2 cents difference. So what's happening here is if implied volatility on Nike were to drop by even 5, 10%, 10 percentage points, whatever, I'm not even sure. Actually, let's say 5 percentage points. It went from 23 down to 18% implied volatility. I would gain about, let me see, 10 cents worth of advantage or profit from the dropping implied volatility. But if the market suddenly did something weird and corrected, implied volatility shoots up and it hurts this trade. Now, it doesn't necessarily mean that that's going to be the final P&L of the trade, but it does mean that while I'm holding on to that trade, my P&L is worse, and if I'm forced out of the trade, I'm taking a greater loss. So that represents a risk to me. If implied volatility increases, I lose money faster. That would happen because of a market correction, which would also likely cause Nike to go down. So I'd lose both because it's a bullish trade and because it's a short volatility trade. Okay, but I like the trade. Yeah, by the way, Andrea, yes, options are closed right now, and we are getting, these are probably bad numbers anyhow, but it allows me to at least explain the trade and walk you through how the whole thing works. So let's assume that I sized this out for my portfolio. I've done all the work. I've got my plan as to how I'm going to manage it, how am I going to do my stop losses, how am I going to do my profit target. My plan on this is just to let it expire on the 24th of February and capture the money. Great. In general, I have what I believe is a smart, well thought out trade. It has a good reason to exist, and in general, it's a good thing. Beautiful. We have the basis of the first trade in our portfolio. Now, are there any, aside from the specifics of how to construct the vertical spread or anything like that, do you understand what I'm talking about, where this is a short volatility trade and it's a long delta trade? Everybody's got that? Okay. And you also understand that we chose this because we feel it is a good trade. We feel like it's a high probability trade. We've actually got about an 80% chance, a little more, of this trade being successful. We think that the trend actually adds to that, makes it even smarter. Yeah, in a lot of ways, I actually think that this is not a bad idea as a trade, period. I'd probably want to put more effort into figuring it out, but it looks like a reasonable trade. But here we have this Nike bull put spread. Now, in fact, I've got a bunch of things somewhat like that in here. Okay. The thing is, if this trade works the way it's supposed to in a normal market, we should be able to make some good money off of it. You know, it gives us an opportunity to make a high probability trade with a reasonable return on investment that overall I'd be happy with. Great. The next trade is where we start to make a difference. Okay. I'm going to go over to Ambarella. Okay, not exactly what I was looking for. Actually, I think it was Avago. Hold on. Yep. Okay. This trade right here, it's a bullish trade. I believe that Avago is going to continue to go up and it's going to be a nice trend. But there's a couple of minor differences here. And this is something we'll go into as we get into the tactics, the very, very specific tactics in the tactics class next. This trade, or this option series, is at the absolutely low end of its own implied volatility range. And I actually had this one in my pocket. I knew I was going to go to this one next. Every stock has a natural range for its own implied volatility. And it's got this invisible middle point that we really don't know exactly where it is, but it's general middle point that when implied volatility drops down too low, it's like an elastic band stretching out and it pulls it back up a bit. If implied volatility gets way too high, that elastic band is stretched out and pulls it back towards the center again. There's a natural level of implied volatility. Now, over a long period of time, that can shift and go down, but in general, that's a function or a way that this all works. So, one of the things that we can use, knowing that, is how can we use that to understand what could possibly happen on implied volatility? One of the things that I do is I have a little indicator that basically looks back across the last 400 days of trading, takes samples of implied volatility, and figures out what percentile rank the current implied volatility is. So at this point, I am at the 4.8th percentile. Now what that means is that over the last 400 trading days, if I took a sample of implied volatility every one of those trading days, there was only 4.8% of those days that had an implied volatility any lower than what it is right now. When I'm this low, any rules to draw the trend line? Yes, my rule is I point my thing over here, and it poof appears. I don't believe in trend lines. I believe they generally make you believe you know more than you know. I usually put a trend line up when I'm trying to make a point that something is generally going in one direction. As a matter of fact, the majority of the time, I don't have any indicators at all on my screen other than this one implied volatility measurement down here. I find in general you can just look at something. If I took this trend line off right here, would you be able to tell that that is consistently and generally trending up? So if you can see that with your plain eyes without the trend line there, the trend line's not actually doing you any good. More often than not, I stick a trend line on when I'm specifically trying to make a class of people understand what's going on. I barely ever use them. I do like lines to help me box in where trades are supposed to stay within. I think that's visually very handy. But things like trends, very rarely ever use those. In fact, I don't even use any technical indicators at all. Don't have a moving average, don't have a Bollinger Band, don't have an ATR, anything on my charts. Now, I'm not saying you have to do it my way. Just realize that in a lot of cases, technical indicators really play to the part of your brain that likes to identify patterns. And they make nice little squiggly lines that look like very, very understandable patterns when they really don't necessarily mean much statistically. And they give you this level of confidence that you know what's going to happen without really giving you any information. And I find that to be a bit dangerous. So that's my approach. I generally just look at the overall big picture, figure out what's broadly happening to the stock, and try to make some judgment calls from there. Make your own path, though. So anyhow, one thing that I do know that is actually statistically provable is there are ranges for implied volatility, and when you get to extreme ends of either one of, either the high or low end of those ranges, there is a greater probability that the implied volatility is going to go up towards the center or down towards the center if you're at an extreme. So whenever I'm at an extreme like this, and 4.8% isn't perfect, but it's pretty darn good. It's basically been under this point very, very few times in history. I can know something from this, and that becomes a very valuable tool for me. I know that it is unlikely that Avago's implied volatility is going to go down anymore. Now, it doesn't guarantee it's going to go up, but I know it's unlikely that it's going to go down anymore at all, or if it does go down a bit more, very, very little amounts. Now, this is trying to focus on what you can know and what you can't know. I can't promise that the implied volatility will go up. I will say there's a good chance that it will go up. Can't promise it will. But I can say that there's very little chance it's going to go down. So this reorients me to a different style of trade, and it actually becomes very important for my portfolio. I am going to use a totally different tactic. I could, if I wanted to, put a bull-put spread on this. But a bull-put spread's not really a good trade for a situation where implied volatility is very low and it's likely to go up. It's a short volatility trade. If implied volatility increased, it would hurt your performance on the trade. It wouldn't help it. On the other hand, by the way, I'm going to do a really simple version of this right now. There's lots of interesting other things that you can do, but I am going to do a very, very simple bull calendar spread, and I'm going to attempt to not have stupid drawings pop up on my screen. First thing I need to do is think through where do I generally believe that this stock is heading, and I'm going to put a timeline on this. Where do I believe this stock is going over the next 3 weeks? All right. Time level. What is an expiration pretty close to about 3 weeks out? February 10th. Excellent. Okay. Easy enough to work with. Going back to the chart, I am going to put a line on here to see where this is ending on February 10th. So here, this is where I would possibly put a trend line in. And no, I'm not doing anything terribly fancy here. Roughly, do I think it's kind of ish, sort of heading in that direction? Yeah. What does that make a target for me? Well, I'm at 186 and my target is about 187. I'm actually going to go a little higher than this. I think that there's a decent chance that we could be hitting 188 or maybe a little higher. Let's see, 188, 189. Actually, I'd say broadly 189 would be a good spot I'm shooting for. What I'm looking for is a point that in the next 3 weeks, I believe we've got a very, very good chance of hitting, but we're not going to shoot past anytime too fast. I don't want to have the chance that this trade can blow by this and hurt me. So I'm going to use 189 as my target price. And this is going to be a calendar trade. Now, we poked around with a vertical spread the other day. This is a horizontal spread. So let me show you how I do this. I've got a February 10th. I have a target price of 189. Now, 189, may not work because I may not have the strikes. Hold on. 189 is what I'm going to use as a general target for my short strike. I'm going to use the February 10th. Now, I don't have a 189, but I do have a 190. Okay, I'll work with that. That's fine. So I'm going to sell it short. Now, if we were doing vertical spread, I would be changing the strike and I'd be buying along. That's not what we're doing. We're actually doing a calendar spread. So I'm selling a 190 call. Now, the strike I'm going for is above the current price. I want to use an option that is, basically that is out of the money, and that would be my call side. If I was believing that the stock was heading down, I would be using puts. It doesn't really matter whether you set the trade up with puts or calls. It ends up being the same, but you get to avoid the assignment risk of having an in-the-money short option. So here I am, 190 strike, sold it short. Now, I'm going to go 1 week out to the February 17th. I'm going to go 190 strike, and I'm going long. Now, between the two, I received a nice significant credit on the short option. I got charged more than the credit was worth on the long option. And between the two, I've got a net debit of 70 cents. All right, not outrageous trade. Actually fairly simple at this point. 70 cents is my total cost of the trade. 70 cents is my max risk. Well, it's actually $70. I can work with this trade, and let's take a look at what this thing looks like. All right, hold on. Clear out a bunch of other trades. There we go. So this is the trade we're looking at, and it's an interesting trade. For 10 of these, we'd be spending $700. We're currently trading at 188, roughly 188 right now. Is that right? Yes, good. So this line represents where we are. If we go up in price today, I would make a little tiny bit of money. As time passes, each day, movement towards that 189 or the 190 strike will make me more and more money, plus time erosion will make me money. The trade can actually make money even if the stock moves a little bit backwards. As long as we stay above about 185, this trade will make money. Now, it's not a ton of space, but it gives us a little advantage. Overall, this is a good trade to make me money if I believe that the Vago is going to slowly be heading up towards 190. Now, the trick is that if it passes 190, I have to basically close the trade down because I'd be losing money if it goes too far along. But a couple of things to pay attention to in this trade. Look at this. I've got $700 worth of cost. But if I left this on and we got further along, and here we are coming up into February, we're getting closer and closer to the 10th when the first option expires. I could be making $627. Actually, if the stock doesn't move, I'm making about $530 at the current price. Nothing else happens. I'm making $530 off of a $700 trade. That's a pretty high return on investment. We're talking up in the, 70% range there? Somewhere in that area? Okay, this is still a bullish trade. I found a good bullish trade, but there's a very big difference with this trade. This one is long volatility. Now, why does that matter? First of all, my other trade was short volatility, which means it got hurt when the market basically goes up in volatility. On the other hand, this trade is actually very, very interesting. Good. Let's do a little bit of quick testing here. Broadcom, Avago, what happened to it during the correction last year? All right, it went down, and at the same time, implied volatility was here up around 48, 49, 50%. Now, it actually even went up higher and hit about 60, 62, 63%. So that's what possibly could happen. It's currently trading with an implied volatility of about 25%. Let's not say it goes all the way to 50. Let's just say that we add, I don't know, 10 to 15% implied volatility to this because the market is going through a correction. Now, Broadcom did get pulled back during the correction, but not that much. This is actually a very minor pullback compared to the rest of the market, which was down about 12 to 15%. So this is, in general, relatively isolated, or it will be minimally affected by the broad market. Gives us our correlation. It helps to reduce our correlations. And at the same time, it still gets an implied volatility bump. Now, if the market were to drop, this bullish trade would get hurt. No question about it. We would get hurt. But we've got some room where this thing can move a little ways. But here is the really important thing on this. This is a long volatility trade, helping to balance off our short volatility trades. Let's add a little volatility to this. Now, before I do that, right now, if this were happening and we were dealing with this on the 8th of February, our break-even point on the downside here is about 183.96. So basically, as long as we stay above 184, we would be okay. Now, theoretically, if we drop below 184, we're starting to lose money, and we would be hurting on this. Probably jumping out of the trade, ejecting, and all of those things. The market goes into correction. It's going to move us down. It's going to hurt us. But it's also going to raise implied volatility. And if the trade is designed correctly, and let's see if it is, let's just add 15% volatility. Oh, yeah. Now, let's take a look at some numbers. Actually, I'm going to be a little less aggressive about that. I'm going to say we only went up by 10% implied volatility. Just 10%. Okay? And remember, during the correction last year, it went up to 50, actually even went into the 60% volatility range. That is a lot. That is not even close to what I adjusted this to. I only went up to about 32% implied volatility on this. And that's what just happened to the trade. My break-even point, which was 184, is now all the way down at 179. If this stock did not move all that much, let's say that we were sitting here still roughly around 188, probably wouldn't happen, but even then, maybe we were down at 185 or something like that. Remember, at that point earlier, I think 185 was actually our end of the trade break even. Not anymore. If we drop down to 185, I'm making $920 off of a $700 trade. Now, that's, what, 130% return on investment? And it's just because of the way that this trade reacts to implied volatility as opposed to the bull-put spread. Now, understand something. This is a double-edged sword. You can set this trade up and do it very, very poorly. If I set this trade up on a symbol that had a mid-level of implied volatility and that volatility dropped, I would have just the opposite effect and my trade would get killed. I would really, really get hurt badly. So it's not like I can do this everywhere. But I can certainly pick and choose. And if I'm taking a trade that's very, very short volatility, and most platforms will actually give you a nice volatility number for the trade, and I want to help balance out the volatility aspects of that, well, I can mix in this style of a trade, which still makes me money from the stock going up, but in this case, it also exposes me to long volatility. The long volatility on this trade helps to neutralize some of the failure of the short volatility in the other trade. And it reduces the volatility overall in your portfolio. It reduces how much you would lose. Now, this is still bullish. So what I just did is I fixed my volatility problem here, but I added to the fact that I am now still very, very bullish in the market. All right, so there's a problem. All right, what do we do next? Does anybody have a thought here? I mean, if we end up, we've got our volatilities relatively neutralized, so volatility is not a major effect, but we still have a lot of exposure. You know, we basically are biasing our portfolio to the market broadly going up. What do you think our next step would be? Remembering the long-short portfolio ideas. There you go. You nailed it. That's it. That's the basic concept. It sounds like this complex mathematical formula, but in truth, it doesn't need to be. You can certainly do it that way if you want, but here's the basic idea of this generalized trading system. You want to be looking for lots of opportunities in the market. You want to be scanning and identifying a wide variety of different trades and different strategies that you can use, and trying to find symbols that are generally not correlated with each other too much. And then as you build those in, you're choosing a good trade. Each time you choose a trade, you want to choose what you feel is a good quality trade with a strong reason to exist. You want to build your plan around it. You want to manage the risks. You want to basically create a good trade. As you put the trades in the portfolio, you reevaluate the portfolio each time to figure out, do I have a lot of long volatility or do I have a lot of short volatility? Do I have a lot of long delta? Am I bullish? Do I have a lot of short delta? Am I bearish? As you're going along and you're evaluating that portfolio, you just try to find trades that basically help fill in the opposite direction. And it's literally that simple, that you don't have to do anything terribly complicated. Your goal is to create that portfolio of 8 to 12 to maybe 14 or 15 trades. You want to build that portfolio out over time. You're going to have some trades that are long-term, some that are short-term, some that are bullish, some that are bearish, some that are neutral, like iron condors or those earnings trades that we did. Some that are long volatility, some short volatility. And as you work through, you evaluate each time, where does my portfolio stand and what would be a benefit to it? And you bias your decisions. If I have 5 trades that I'm possibly looking at, and 2 of those help to bring my vega and my delta back closer to zero, that's the goal, is to balance it off so that you're trying to get them closer to zero, then what I'm doing is I'm creating a more and more resilient portfolio. In fact, I could very easily do the same exact style of trade over on Ambarella that we were looking at a second ago. Now, we're not quite at the lowest implied volatility, so I'd hesitate a bit. But here, we've got Ambarella heading down. We have an implied volatility that's at about its 15th percentile. I'd consider that a little bit high implied volatility, but not horrible. We could even potentially use the earnings announcement coming up to bias the volatility to up. We could actually put our long option after the earnings announcement and use the earnings announcement to raise the implied volatility on that. And we can create a nice little trade that, let's see, Ambarella is roughly heading to about 44.50, and I expect that to happen in about 2-3 weeks. Not get quite so aggressive on this. And let's say 45 by 45. 20-cent debit, actually very inexpensive trade. Analyze this. Here we go. This is a bearish trade for Ambarella. In fact, it's a very negative delta trade, which means it's going to make a lot of money quickly from downward price movement. This is, by the way, notice that I'm not inside my break-even points at this point, so we do really need to get some good solid movement on Ambarella for this trade to work. But at the same time, it's also very, very sensitive to the rising implied volatility. So if the market were to crash, it's going to make Ambarella move a little quicker. It's going to raise implied volatility at the same time. And it is going to generate a greater P&L like this. In fact, if we get 2 of those working together and it causes Ambarella to move down past our 45 strike, we are looking at a $200 trade right here. By the way, this is in the 8th. This isn't even on the very end. This is getting into the last week or so. I'm making $573 on a $200 trade, mainly because the implied volatility went up and I've got a moderately highly leveraged trade delta-wise. But this delta rate here offsets the deltas, the long deltas. If we had a correction and the market started going down, it would pull Ambarella down with it. We would have to still manage our trade and close it down, but we would be making more and more and more money as implied volatility went up and as Ambarella was moving down towards our 45 strike. That profit that you have in this trade would basically balance off a whole bunch of losses that you would have in the other trades. Once again, we're trying to create a portfolio that's guided towards basically delta of 0, neutral generally, and vega of 0, neutral across the volatilities. So I have only got a couple more minutes here and we've got to wrap this up. I've actually gotten to the end of the part that I wanted to teach today. But what do you have for questions? Actually, first one for you. Does everybody get the general idea of what we're doing here? Taking the knowledge that you got from the Greeks yesterday, and then as you build out more and more tactics, put a little bit of time into understanding what each of the tactics, the trade styles, the iron condor, the vertical spreads, things, what are they going to do in the terms of the Greeks into your portfolio? And then basically work around the basic idea of every trade works you back towards as close to 0 delta and 0 vega as you can. You can't get perfect. Don't even try. But just as you're jumping over 0 back and forth, you are trying to guide your portfolio in as a well-diversified portfolio with lots of good ideas, good trades, and then use this process to balance it out so that you are very, very resilient against a large-scale price movement. Does that make sense? You understand it? Okay, good. It's once you start to get the idea, it actually feels right. John, you were asking about this earlier. Is this generally what you were thinking of when you were asking your questions earlier? Yep. As a matter of fact, keep it simple at first. Don't try to get outrageously complex about this. Don't try to figure out what would my Greeks be if the market dropped 5% or 10%. Just each time that you add a trade in, evaluate where your Greeks are, and it should be pretty simple. Almost every trading platform will allow you to have a little portfolio view and see some of your Greeks. In fact, if you can do a beta weighting of it, you're even better. And figure out, do I need to, what style of a trade would I need to use to get me a little bit closer to 0? You know, if you try to go complicated, and believe me, there are a ton of horrendously complicated formulas for doing this and strategies for doing this that will not get you radically better results than the simple approach I'm telling you. If you've got a lot of long vega, try to find some trades that are going to get you in on the short vega. If you've got a lot of long delta, try to find some bearish trades that are going to get you in to the bearish delta and down towards 0 a little more. Every trade that you put on brings you back closer to balance. Things will adjust and things will shift. But if you keep the process up and you make it a regular part of your trading and you actively look for more and more opportunities and trades and then pick the ones that build your portfolio into a more reliable, steady tool for making money, you're going to come out a lot ahead. So I guess, John, what I want you to avoid is asking me the question of what is this mathematical thing that I have to do to find the answer? Really, that's not what you should look for. It's just simple. You know, do I have a ton of long vega? Well, your platform should be able to tell you, do you have a great big positive amount of vega on? I can do it on Thinkorswim. I can do it on Options House. Most trade platforms will let you do that. It'll give you a number right at the bottom. In fact, here, monitor, activity positions, blah, blah, blah. Let me get into one of these. I'm going to use this button right here, which is called beta weighting. And that basically means that, okay, I'm going to beta weight against SPY. If the market were to move, what would my overall exposure to this or that be? Now, I don't know why it's balking on the delta. I think I must have some bad things in here, but I don't have a high amount of delta, period. But I do have quite a bit of volatility exposure. I am very long volatility right now across all of my trades. So on average, if the market went up about 1% implied volatility, I would gain about 1,165. But that means that I want to put in some trades that are short volatility. Well, I pick from my short volatility list. My vertical spreads, my iron condors, whole list of them, and that'll add short Vega and bring me back to zero. Theta I don't care about. I'm not sure why delta is failing me here, but and that's basically it. Simple. No, if you really want one, I can give you a differential equation that actually has multiple parts and bits and pieces, but as I said, I can teach this to you horrendously complicated, or I can teach it to you in a simple thought process that will get you effective results without killing you with a bunch of complicated stuff. And that's what I want. Now, just that thing right there, that idea, is a very powerful way of improving your portfolio. Lou, thank you for mentioning that. I almost forgot it. Let's take a quick look at that. Lou is asking me how do I use VXX to hedge? And Lou, I have to do this very quick. I apologize for rushing through this, but if you're in my option strategist group, we'll be doing this relatively regularly, and you'll get to see it in action a few times. It's a strategy I use a lot. All right, let me tell you the weakness and a little bit of a reality check on the portfolio approach to trading. Now, first of all, before I jump into anything different, does anybody have any questions at all, other than Lou's question about VXX, about portfolio approach to trading and the general concept of how you'd use that to pull all of your trading together and basically make it better? No, VIX options are horrible, Lou. Terrible, terrible, evil things. And I'll show you why in just a second. Actually, out of curiosity, Lou, SPY options are on the SPYs. Ambarella options have the underlying of Ambarella. What do VIX options have the underlying of? Anybody have any questions before we move on? Anybody? Going, and gone. Lou, do you have an answer for me? What are the underlying assets underneath VIX options? If you don't know, it's no big deal. Nope, not SPX. Andrea, you're close, but not quite. They're not the futures of options underlying VIX options, because there's no futures of options. They are the futures of the VIX index, which is a mathematical formula that doesn't actually have any assets. So VIX options, the underlying is not one thing. In fact, every expiration of VIX options that you get has a totally different asset underlying it. And let me show you in one quick chart why that ends up being a horribly bad problem. Another great site to go to, VIX Central. VIXCentral.com. Yeah, Andrea, it is weird. They're some of the most weird options. And no, hit can. Okay. It is not SPY standard deviation either. It is actually a mathematical formula that analyzes in a fairly strict way the average, a weighted average of the implied volatility on multiple expirations and multiple strikes of the options on the assets that underlie the S&P 500. Okay, and believe me, if that sounded complex, actually doing it is more complex. They're actually taking a formula and averaging the implied volatility of the assets that are in the S&P 500 by weight figuring out the weighted average of all of those using a special formula across multiple expirations and multiple strikes to generate the VIX. It's a horrendous formula. It's really complex, lots of pieces. And the futures contracts actually are based off of the price of the VIX index from that formula at a certain moment of time when the futures contracts expire. So that's what determines the futures value. Now, people are speculating on what that value will be. That's what's called a forward price. They're estimating what the forward price of the VIX will be in the future. Now, a forward price always interprets what the potential for a spike or a rapid change of price between now and the expiration in the future is going to be also. So you get some weird effects in there. VIX options are actually based on the futures contract that expires the day after I believe it's the futures contract that expires the day after the VIX of the options contract expires for the VIX options. So in reality, you could be sitting here, and if I was trading a VIX option that expired in March, the March monthly option, and the VIX is currently trading at $12.78. You'd be wondering what the heck is going on with your options, because the price of the options don't seem to be related to $12.78 at all. What they are related to is the $15.60 that's the current price of the March expiration futures contract that is tied to the VIX index that expires, that is at the moment of time, that will happen at the moment of time that these futures contracts expire. So is that complicated enough for you? Actually, Lou, there's more contracts going on VXX than there are on VIX. It's a higher volume options contract in general. Doesn't necessarily mean that people don't trade VIX. There is a lot of trading on VIX for a very specific reason, because you can create a very unique set of trades that are actually normally quite hard to do off of the differential between these expirations, and you can play a squeeze trade between the two. And that will cause a lot of volume in VIX options, but they are not playing the same game you are. They're playing a very, very different game. It's a form of, it's a form of time differential volatility arbitrage. It's a weird one. Basically, they are trading the slope of the contango situation in the VIX futures contracts, and they're using options to do it. So, tell you what, get through the tactics class, spend about 6 months deep in options, and then we'll dive into that trade. It's not for the weak of, it's not for the weak of heart here. Okay. Now, why would I use VXX instead? I could use these in some ways to hedge. The problem is, I just explained, they're intensely complicated. VXX, on the other hand, actually simplifies things. It doesn't fix every problem, but it simplifies things. VXX is actually what's called an ETN, an exchange traded note. It's a legal contract which binds you to basically a formula that defines a set of underlying assets. And the formula for this is that Barclays Bank, which underwrites the VXX, has to maintain a certain asset base of VIX futures with a blend of futures contracts that expire more than 30 days in the future, and mixing that with a blend that expires less than 30 days in the future. And the ratio of those two means that the average expiration date is 30 days. So that means every single day that moves forward, they have to basically buy more long-term VIX futures contracts and sell some of their short-term ones. So they rebalance this to 30 days every day. Now, that right there, if I'm buying expensive and selling cheap, that basically means that I'm losing money. And Barclays Bank is a wonderfully noble institution who would never think of hurting any of their customers or manipulating any, I don't know, LIBOR indexes or anything like that in any way. Such a wonderful group that obviously they're just taking them on the chin and not passing that cost on to customers. Or maybe that was just a big line of BS. Of course they're passing it on. All of the losses they incur from rebalancing the VXX ETN on a daily basis, because like I said, it's underlying the VXX is a set of futures contracts that are supposed to average, have an expiration of 30 days in the future. As they generate losses doing that, they pass it on to the price of VXX, which then causes this. See that? Long downtrend. That is because of contango erosion. Now, that is our enemy in this situation. Oh man, I've got to get going here. Sorry about this. Let me do this really quick, Lou. I'm going to give you the short version. So, why do I use VXX? I know that it's going to go down in price, but I also know that a couple other things are going on. Number one, the options contracts partially, not completely, but partially pre-bake in to their pricing the fact that VXX is an eroding asset. And honestly, there's not much better out there that's going to give you a better asset to work from. What happens is when the market goes through a major correction, the VXX jumps up. I would expect to see the VXX jump up to about double its price if we were to go through a normal 10 to 15% market correction, similar to what we saw several times over the last few years. So whatever it's at now, which is currently about 2098, I would expect us to fairly easily double that during that process. Now, problem is that if I wait 3 months, VIX might be at 15 and doubling it might be 30. There is a challenge there. There's a problem. What I do is this. I pick an expiration relatively far off in the future. Not too far off, but not too close either. In this case, I'm going to use the 3rd of March because it's actually I'll use the 17th of March. That's a monthly. It gives me 57 days. Now, there's a trade-off. The further out you go, the less you're paying for your protection on a per-day basis. But the worse the protection is, quality-wise. Now, follow along with this because I am already about 12 minutes late for what I'm supposed to be doing. So you guys are getting more of my time here. Sorry to rush though. I need to find a strike, a call strike on the VXX that expires 57 days out. This is what I'm going to work with. I need to get one that I am very, very comfortable that during a market correction I stand a good chance that the stock or VXX is going to go well past this. So in this case, I'm going to go and hit, I'm going to say about 34. Okay. So I'm starting out with a 34 strike. Now I have a couple of rules of thumb that I use on this. First of all, I am buying a long call. All right. That is going to cost me about 49 cents-ish. I am going to go about $3 out. What I'm going to do, this long call has got a bunch of problems. If VIX jumps up, there's a number of reasons why this is not a good hedge by itself. You've got a ton of theta erosion, it becomes less effective over time, all kinds of different things. I need to make some of those problems go away. Plus, it's expensive. For the protection that I want, I am not going to get what I need out of this long call. This doesn't work very well. But if I go about $3 out and I go short, I can turn this into a wonderful, handy-dandy bull call spread. Now, the debit on this is very, very cheap. In this case, 12 cents. I've got a $3 spread. What does this mean? It means that the max money I can make is $3 and I'm spending 12 cents to do it. Now, I have a target in mind of what I would like to see. I would like to see the ratio of what I can get profit-wise to what I'm spending to be about 14 or 15. Right now, I'm starting at 12 cents debit. That's actually too low. Let me show you how you figure that out. $3 minus 12 cents is I can make a max of 288. Divide that by the 12 cents cost. That would be a 24 ratio. Okay, Now that sounds wonderful. I'm leveraging my trade up so that for every dollar I put in, I can make 24 bucks. Problem is that also represents the fact that I am not likely to hit this if the market goes into correction. We're going to shift this lower. So I'm going to go down to about 31 by 34. Let's see if we're a little bit better. We're closer. I'm going to go a little bit lower. Let's see, 30 by 33. 20 cents. That's about right. Let's see where we stand. Yeah, we'll have to catch up on that. Lou, what's more than the expected move? The strike? Remember, I'm basing this off of a current price of 21.54. So if the market were to go into a full-on correction, we'd probably see a doubling of VIX or VXX. That would drive the VXX up to about 44 based on today's pricing. Now, 2 or 3 months down the road, it will be a little less. It will be less. But just, at this point, this is a pretty good spot to work from. Now, I am shifting these strikes down until I get roughly about a 15-to-1 ratio. So $3 minus 20 cents, $2.80, divided by 20 cents, my cost, 14. Boom. We are right where we want to be. Good. This number, 14, notice that as we get that lower and lower, we're basically bringing our strikes lower and lower, getting closer to the current price of VXX. That makes the hedge more responsive and better for protecting us. Now, we are going to pay 20 cents for every one of these that we could potentially make $2.80 on. That's a huge amount of leverage. But flat out, the odds on this trade working and making us money are slim to none, and we don't want it to work. Because basically, if this is working, it means that the rest of our portfolio is failing. So we need to do a little bit of work, first of all. We need to take a little bit of time. We need to evaluate what we normally have as a portfolio and what we're normally at risk. My recommendation is this. Figure out what you normally have and take a sample of your portfolio right now. Go back to what happened during the beginning of last year, January of 2016. Take a look at all your stocks and see what kind of a percentage move they did as the market crashed down. And also take a look at the relatively the same options on those stocks at that time and see what the implied volatilities of those options did. Take your current portfolio and change it by that. Drop the prices down by whatever percentage they lost during that correction. Raise the implied volatility of the options up to about the level they went to during that correction. And take a look at your P&L across your portfolio. It's going to be scary. You're going to be a little nervous, and it's going to tell you how much you can lose. I did the evaluation, and I've got about, on a normal portfolio of mine, for about $100,000, I have about $8,000 worth of risk. Okay, so my goal is to basically hedge off a good portion of an $8,000 loss. So I need to get a couple of things going on here. First of all, this number, my 14-to-1 leverage on this trade right here, is not 100% accurate. Reality is I'm never going to make the whole thing. So first thing I do is just times it times 0.8. I assume I'm going to make about 80%. So I reduced my theoretical leverage, bringing it in something a bit more practical. My now new leverage is 11.2. Okay, that number allows me to do something nice and simple. Figure out how many of these VXX trades I have to take to basically hedge my portfolio. Wow, I'm getting so late right now. I have $8,000 worth of portfolio losses to mitigate the loss on, to reduce the loss. So $8,000 divided by 11.2. I have to spend $714 on this trade to get $8,000 worth of rough protection for my portfolio. Okay, these are $20 a piece. I need to spend $714 divided by 20. I buy 35 of them. Boom. 35 contracts. I now have a VXX bull call spread 35 contracts. It's going to cost me about $700-ish. Actually, it's going to cost $700 to put on. If I analyze this trade, this is what we've got. VXX is down here right now. Unless something crazy happens, it's not likely to go up. But if it does, and we hit up about the 40 range, my trade right there is hitting about $10,000 worth of profit. That's a little more than my $8,000. So I am actually a little overhedged in this case. I actually did a double check. Oops, sorry, I had two of these on. There we are, a little bit more accurate. So if this were to happen right away, early in the process, I would be a little underhedged. If it happened late in the process, I'd be probably a bit overhedged, because this actually gets steeper and more effective as time passes. So that right there is the general process that you would use to determine how much of a hedge you would put on. You don't want to spend much on this. This is a lost cause. I mean, the idea is this trade is specifically there so that you do not lose your shirt when the market crashes. You want to be able to walk away from that with money in your pocket and be able to continue trading without too much of a loss. You do not want to try to turn this into a profit center, because the odds of you winning this are slim to none. So Lou, did that give you the general idea? Hopefully you can rewatch the video and maybe get a little slowed down version of that. And I will do this in the Option Strategist group several times over the next couple of months, as we'll do small hedges to put these on. But that's the basic idea that I would use for that. And really, I mean, for a $100,000 portfolio, I just spent $700 to protect it, to protect a lot of it. You know, $8,000 worth of losses, I can pretty much make go away. If I combine that with a well-balanced portfolio, I walk away from what's normally a bad situation where everybody else is losing 10, 12, 15% of their portfolio, and I end up losing 2 to 3%. So I win. All right. Sorry to do this, but I have to jump. I literally am already very, very late. Sorry about that. Anybody have any questions? Any quick questions? Everybody good? Well, for those of you who came for the foundation sessions, thank you a lot. We have just reached the end. For those of you who are going to continue on to the tactics course next week, can't wait to see you again. I'll see you on Monday. We've got 4 days of diving into specifically how each of these trades work, how to make them all fit together, and basically how to take all the ideas that we've got so far and piece them together into live trades. And beyond that, we've got the Option Strategist group. We meet every week, hoping to see you in that. I believe that most of you actually have access to that. If you don't, reach out to your salesperson and at least ask for free trial for a period of time, and that'll give you a chance to take some of the ideas that we've got and actually turn them into live trades in the market. And you know, as Rob and John saw today, or yesterday I should say, we spend a lot of time in those Option Strategist group classes, strategy sessions, diving into not just making a trade, but understanding how and why we're making a trade. I mean, we're taking all of the things that we've talked about here and actually employing it in the market in a smart way. And we talk about every decision we make as we go. Why am I considering this information? Why wouldn't I do this as opposed to this? You know, how do I decide on which strike? How do I decide on which expiration? How do I decide on my risk management? We get into that and we actually do it on live trades. It gives a really good chance to get a feel for what's going on and really manage, you know, get a real hands-on view of trading that's way beyond just pure teaching. So love to see you in that, and I know that if you ask your sales rep, they'll at least get you in for a period of time for a free trial. If it's good, love to see you more. I believe the recordings are coming out tomorrow. But all right, everybody, final goodbyes. Thanks a lot, and I will see those of you with me on the tactics course next Monday. See you later.